Hey everyone, in today's video, we're going to talk about the three Canadian banks that I own in my stock portfolio. Now, before getting into this video and the three that I own, all of the Canadian banks, generally speaking, over a longer period of time, have been very good investments. They essentially own an oligopoly across the Canadian economy, and they perform really well, even globally speaking. They have some great exposure. But in this video, I'm going to go through the three that I personally own. And then at the end, I'm going to talk about why these are the three that I decided to invest in over some of the other ones that are available in Canada. Okay, so getting into this one, the first one here is TD Bank. TD Bank here currently trading at $83 a share. We're getting a 4.6% starting dividend yield on it. Looking very long term, and you'll see this very similarly on all of the Canadian banks, but really strong up into the right movement, creating capital appreciation over time in addition to the nice dividend payments. You can see the stock actually hit a high of about $106 early in 2022, currently down at $83. Since then, there's been a bit of pessimism in the global economy. There's been higher interest rates making or pushing down on consumer discretionary spending and some other things that may impact the economy. And deals being done in the financial markets that all these banks tend to take part of and get commissions from. So there's good reason for why the banks maybe have had a bit of a step down. But we'll go through some of the valuations to see if it's really deserving of over a 20% correction here on TD Bank. Very big bank in terms of overall size. You see here $153 billion. Going into the bank a bit more, you can see here where their exposure lies. So very heavy in kind of southern Ontario and then into the northeast of the United States. They have 2,300 locations across US and Canada. You can see that they don't really operate in central US or west US. They're really Canada and then the east side of the US there. In terms of some of their overall metrics here, you can kind of see they're either the number one or number two bank in Canada, depending on the metric and what you're scorecarding. RBC is the other really big bank in Canada. But then what lots of people don't know is TD Bank's actually one of the biggest banks in North America. You see here being the fifth or sixth biggest bank across North America on things like assets, deposits, market cap. So this is a really, really big bank, even in the scheme of North America, not just the Canadian markets, which lots of Canadians may be surprised to hear about their US presence to that degree. One of the great things about all of the banks is the dividends. So TD Bank here, you can see, has paid 166 years in a row of dividends. Current yield of 4.5%. But even after over the last 30 years, they're compounding that growth rate in double digits. And even at the dividend payment right now, 4.5%, they're paying less than 50% of their profits out as dividends. So that means they're also creating lots of value that isn't going out the door to shareholders in the short term, but could hopefully be invested in mergers and acquisitions and building out new infrastructures and technology and new capabilities that can really help drive capital appreciation and earnings power longer term, which should then fuel that dividend growth over the long term. So they've really figured out and executed on the value creation model for shareholders over the last number of decades. And you can just see it here in terms of how well they've been compounding the dividend and increasing the dividend every single year. And I expect them to continue to do that into the future with their payout ratios as low as they are, as well as just the fundamental role they play in society. So this kind of is indicative of all the Canadian banks, but TD Bank especially has a very strong dividend growth history here that I really wanted to highlight for you guys. In terms of their earnings mix, you can see here, in terms of where they're getting the majority of their profits from, 75% is from retail banking for the most part, between the Canadian bank and the US retail bank, 30%, 44%. They've also have a wealth management and insurance business, which is about 15%. They own a percentage of Charles Schwab through the merger with TD Ameritrade, so they own about 5% of their earnings coming from that investment, and they do some wholesale banking there too. So personally, one of the reasons I love TD is because I feel like they are one of the more defensible banks having so much of the business in retail operations is much less volatile than, let's say, capital markets that RBC has, or some um, of the global elements of even Scotiabank having presence in Latin America. They're just retail banking in core developed markets is the crux of their profit. So I really like that aspect. I think it takes lots of volatility and a lot of consistency, or puts a lot of consistency into the company for TD. Lastly, here they kind of look at their medium-term financial targets. So they're expected to grow their adjusted EPS high single digits, return on equity over 16%, keep their dividend ratio 40 to 50%. So if you're keeping your dividend payout ratio the same, but you're going to grow EPS 7 to 10%, you're pretty much forecasting over the medium term that you're going to be growing your dividend 7 to 10% a year over the medium term. So even though you're getting 4.5% today, which is still a pretty strong yield, 2, 3, 4 years from now, that's going to go up to 5, 6, 7% yield on cost from what you buy today. Going into their current price to earnings, you see here they're expected to do about $8.30 next year, trading at about $8 or $84. So trading right around 10 times earnings for this stock. So I always just take a step back and say, if I was to bring you a stock or talk about a stock that was trading at a 10 times price to earnings ratio, had a 50 plus year dividend growth history on the stock with a starting yield of 4.5%, and expecting to grow their earnings per share in the high single digits or low double digits over the medium term, would you be interested in that stock without talking about what sector it's in or anything else? And I think generally speaking, people would say yes. So I think these banks are in great value, in great position, given what they've accomplished backwards looking, but also what they are striving to accomplish and still trying to prove out to be a growth company forward looking. So that's TD Bank. TD Bank is my number one position in Canadian banks and out of the top 3 banks that I own here. The second bank that I own is Canadian Imperial Bank of Commerce, also known as CIBC. Much smaller business. You see here only $50 billion. That's compared to TD's $150 billion, so about a third the size of TD. First thing that kind of jumps out here is the dividend. You get a 6.3% starting dividend yield there on CIBC. Looking at this one longer term, it also has a really strong track record. It's lagged some of the other big banks a bit. I think their lack of ability to achieve scale and breakout in the US and other markets has really impacted their ability to grow. But they still have done really well over the last number of years. Last 5 years, you can see here, it's actually slowed down. They went all the way up to $80 during those highs, but has actually come down significantly harder since then. I think there's a couple reasons for that we'll talk about here. Just looking at the overall bank here, you can see their overall exposure to Canada, about 75% of their business. They do have a capital markets business that's about 1/3 of their business in terms of net income. So that's one thing that some may feel like is concerning or volatile. Continuing on here, just looking at some of their strategic pillars, they want to grow their North American private wealth business in terms of money that they have coming in, assets under management that they can then charge on. They want to look at digital and becoming more of a digital bank and making those digital investments to incentivize adoption. So that's great, and I'm sure they're doing a great job. The one barrier with CIBC versus these other big banks is just the scale. TD, with 3 times the market cap, 3 times the amount of customers, if they make a digital investment, it has a much broader payout, and they can make bigger investments when you have that many people. But on the smaller big banks, it makes the return on equity and the return on investments a bit less when the outcome or the people using the product will be less at the end of the day. So that's the only challenge relative to some of the other big banks that a smaller big bank like CIBC has in making those investments and seeing the payouts and the ROEs and ROIs come through to the same extent. And then enabling and simplifying is a third pillar that they lay out there. Looking at their loan book. So you see here over 50% of the loan book is in mortgages. So I personally don't mind that too much. I think the protections in terms of the amount of equity they make consumers put in along the lines of other protections that they have and levels of insurance, I don't think the Canadian housing market will crash to the degree that this will turn incredibly painful for them. But I feel like this is one of the reasons why investors trade CIBC at a lower multiple, is their exposure to the Canadian housing market. You can see some of the other areas they're invested in here. Commercial real estate is one that investors don't love. Only 11% for them, so not a huge part of the mix, but still relevant. And then other business and government loans, 25% there. Continuing to truck along, I found this one to be interesting. They're kind of positioning the Canadian housing market as being very low risk compared to competitors or competing countries. So the blue is the UK, the black is the US in terms of mortgage arrears as a percentage of total mortgages. So you can see here that in 2008, that number went all the way up to 4 or 5% of people that were behind on paying their mortgage in the US. The UK, it went to about 2.5%. In Canada, it ticked up from about 0.3 to 0.5%. So it's way less of a thing here for consumers to back out of their mortgage or go into arrears on their mortgage. Seems like it's a really big priority for people to be paying off their mortgage on a monthly basis in Canada. It's really interesting, even as the decade's gone on, how much Canada's really stabilized and just isn't as volatile as what's happening in the US or the UK in terms of mortgage payments as well. And then lastly, I had a nice chart on the TD one, but if we go back 10 years, CIBC was paying about 47 cents a share. And then here today, after they increase it every single year, we're all the way up to about 87 cents. So almost a double up in the dividend per share payment over 10 years. Definitely not too bad, especially for a company with a starting yield as high as theirs. And in terms of just their income and their revenue, you can kind of see it here. Very profitable company. On $6 billion in revenue, they did about $1.5 billion in net income, so 25% margins there. Their return on shareholders' equity is a bit lower than I'd like it to see. I'd like to see at least like a mid-teens for a bank, but it seems like they are hitting that in some periods, just not all the time. So that's something that I keep an eye on just to make sure they're getting good return on investments. And then annualized returns here, you'll see in the last year they haven't been doing too well. But over the long term, they've still delivered, let's call it mediocre results to shareholders. 9% a year over the last 10 years. That's actually pretty good. And then 5% a year over the last 5 years, given the slowdown that they've had on their stock price, even though they've made up for that by paying that big dividend that we have seen. Here's another look at their dividend growth. So you see 15-year CAGR, about 5%. So definitely probably less growth than you'll get on TD, but you'll get an extra 1.5 to 2 points of starting yield here that you don't get on TD. Looking at their earnings here, so CIBC has earnings of $6.75 both this year and next year. So they're trading at right around 8 times earnings for this company. You're getting 6.5% yield pretty much, and they're still making about $750 or a couple $2-3 billion that they're reinvesting in the business to drive future growth. So I think this one, again, some more risks to it, less geographically diversified, really only exposure to Canada, about 3/4 of their income. On top of that, they have a huge mortgage book. They have some capital markets exposure. But the reason I'm invested in CIBC is just it is dirt cheap from a valuation standpoint. 8 times earnings. I don't necessarily think many of those shoes are going to fall on them in terms of the mortgage book, the lack of geographical diversification. Canada's a great place to do business, very developed market, developed economy. So I overall think the risk reward on this one is good given the valuation they're at, and I don't mind taking the starting yield of 6.3% that tends to grow every single year. Okay, going into the third and final Canadian bank stock I own. It is the Bank of Nova Scotia. Similar dividend yield as CIBC here at about 6.5%. Looking at this one over the last 5 years, also been down, but longer term, same growth trend as TD, CIBC, perform really well over the last 20, 30 years on this stock here. Looking at some more information about it, you can kind of see their main 4 units here. Canadian banking growing a couple percent there. International banking up 8%. That really breaks down. Latin America here is up 8%. Asia there up, or maybe looks like it's down 9% actually. You can barely see it because it's so small. And then CCA up 8% there. Global wealth management just up 2%, and then global banking and markets up 17%. So from revenue, they've been doing fine. It's really just provision for credit loss and some other areas where they've been losing more money than usual on. In terms of their capital position, I think that banks are going to have to be at about 12% in Canada in terms of capital position. And you can see here they're currently between 12 and 13. So they're in a good spot. They're expecting for this to grow even further throughout the rest of the fiscal. But at some point, holding too much capital becomes like a burden because you can be investing that, getting a return on equity, return on investment on those funds. So I'd say this is okay to be in this 12 to 13 range, especially with the scare that investors got in the U.S. with companies banks not being properly capitalized. If you look at assets, you can see here, this is one sign that wasn't good. You can see it lost about $10 billion in assets from 450 to 440. Some of that was FX because some of these assets are held in Latin America and stuff like that. Generally, that's not a great sign, but just down 2%. So we'll see how that develops over time. I found this to be really interesting. It's loans from consumers that are 90 days overdue as a percentage of total loans. So you can just get a sense for how strong the loan books are at these big banks. They take so much. They are so careful in who they loan to on the big banks. That's why these companies like Easy Financial and companies that offer loans to people who can't get them at big banks even exist, because they only want the best of the best typically when you're talking about the big banks. And that really shows in their 90 days past due. So on mortgages, you can see here about 14 basis points last quarter, and that's even a tick up. So you're seeing slight tick ups on personal loans, 63 basis points, slight tick up from around 50, 55. Credit cards actually down about 60 basis points, and then unsecured line of credits are 22 basis points. That's pretty standard over the last few quarters. So all in all, in total, about 22 basis points of loans are 90 days past due. So for the most part, people are paying their debts that they have to the banks. And if they aren't, they are kind of correcting for it at least in the 90 days after that they've missed their payments. You can see that just jump up tenfold when you go international. Credit cards, 2.8%, personal loans, 3.6%, even mortgages, 2.3%. So lots of this is Latin America, stuff like that. And that's the portion of their business that they've really been having some challenges on, and that's really weighed down on their stock. Looking at their overall deposit growth here, always great to see more deposits coming into the company. That means it's lots of liquidity, lots of customers trusting the bank, and they can use those deposits to get net interest margin on. So you can kind of see here some of the mix of the deposit growth that they have across their business. If you want to just pause and take a closer look, you can. And then lastly, similar to TD, similar to CIBC, the dividend payments, if we look back even just 5 years, from 85 cents in 2019 to $1.06, that's about a 20-25% increase in the dividend in the last 5 years. And that's during a 5-year span that this bank's had tons of challenges. So you can kind of get a sense that even in bad times, these companies still have enough room in terms of profitability, in terms of payout ratio to increase the dividend year in and year out. Looking at the overall valuation here, analysts are expecting about $7.25 of EPS next year on Scotiabank. So at $65, it's trading right at around 9 times. So the reason that I own the Bank of Nova Scotia, or Scotiabank, is because I did not have a lot of exposure to Latin America, and they're like the number 3, number 4 bank in countries like Mexico, Peru, Colombia, Chile. So I thought that was great exposure into those markets to just diversify geographically more of my banking positions. And that's why I still like Scotiabank, because of their presence down there. Now, it hasn't been great over the last few years because of those investments. But, that's what happens with investing. You get exposure to different businesses, different economies, and sometimes they don't all work out in the short term. But long term, I like being diversified. I like the exposure I have there. and at 9 times earnings, lots of the sentiments around the other banks in terms of just the overall valuations being at a good place, starting dividend yields being at a good place, dividend growth opportunities being there, all play into Bank of Nova Scotia, in my opinion, as well. So those are the 3 banks I own. My biggest position is in TD Bank. Reason being, think they're just the most solid bank, least volatile bank in Canada. Great U.S. exposure on the east side of the country, which is really the side that's been growing more. Great Canadian business, great commercial business. Also has some other diversifiers like their exposure in Charles Schwab and some other investments that they've made. I also like their ability to derive scale from digital investments given how big their customer base is. The second stock that I own, just to summarize, CIBC, just cheapest valuation. I understand that they are somewhat overexposed on mortgages. They're not as well geographically diversified. They're really betting big on the Canadian economy in terms of their exposure. But that's why I have an entire portfolio of businesses that operate in other countries. I can make a play that's Canadian specific on one of my positions if it's trading at a significant discount. So I like the 8 times earnings that I get. Sorry about that. I like the 8 times earnings that I'm getting on this name. And in addition to that 6.3% starting dividend yield, same story as the other ones, great dividend growth history on this one. And then going into the last one, Bank of Nova Scotia. Bank of Nova Scotia, even though it's weighed down, like I was saying, love the exposure geographically to Latin America. Love the starting dividend yield of 6.5% as well on this one. So these are the 3 Canadian bank stocks I own. In terms of some of the other ones, BMO, if I just type it in here, BMO also has a very similar layout as TD. They operate in Canada and the US mainly, but they operate more on the west side of the US. And they're a bit of a smaller bank overall at about 85 billion. So that's why I prefer TD over them. They get more scale on digital investments. They get more exposure to the east side, which I like to see. RBC is a great bank. I think by market cap, probably the biggest one that we got, 172. But they have a huge capital markets division, which I don't really want exposure to. And then it's other banks like National Bank that are more like CIBC as well, if I can find National Bank. But for some of the reasons that I don't love Bank of like CIBC in terms of their lack of size that they can derive scale on for digital investments and stuff, that also applies to National Bank. Looks like they also have a bigger PE too and a lower dividend yield. So that's why I'm in the 3 that I'm in. Let me know what Canadian bank stocks you guys own in the comments. Would love to hear from you if you have a difference of opinion on any of these. And if you like this kind of content and you watch till the end, thank you so much. It would be great if you just give this video a big thumbs up. It really does help with the YouTube algorithm. And if you haven't yet, consider subscribing to the channel. Currently at 1,300 and change subscribers. Let's try to get up to 1,500. Thank you guys so much for watching, and I'll see you in the next one.